Joining us today is Jacob Taylor, who is President and CEO of Farnam Street Investments and Managing Partner of Farnam Street Investors. Jake received his MBA in Finance and Accounting from the University of California, Davis, and his partner in Farnam Street Investments is Lonnie Rush, and they both also are visiting instructors at the UC Davis Graduate School of Management, where they teach value investing. Jake, could you tell us a little bit about your background, what got you into value investing, and kind of the genesis of the firm you manage today?
Sure, no problem. My background is actually in the energy industry, running the grid for the state of California. So it's kind of a little bit unconventional, but I'd gone back to get my MBA at Davis, and my first year I happened to win a lottery drawing to go have lunch with Warren Buffett. So I went back to Omaha and, me and some other classmates, and I was absolutely blown away by how amazing Mr. Buffett was, and just he had a well thought out, articulate answer to every question. And I just thought to myself, man, I need to copy this guy. So that was what got the wheel officially turning. I came back and started, reading tons and tons of books about Buffett and value investing, and met up with my business partner, who was also actually in the energy industry and a big Buffett follower, and we decided to launch a fund together. And since then, we also, like you said, we started teaching, which was kind of also an ode to Buffett. It's not commonly known, but he was when he was 21, he taught a class at University of Nebraska in Omaha on investment principles, he called it. And so, we figured if we're going to copy him, we might as well do everything and do it right. So it turned out that we really enjoyed the teaching, and we've been doing it ever since. So this summer coming up will be our fourth time teaching, and it's kind of one of our favorite parts of this job.
And in your classes or lectures, do you talk about actual investments that maybe you guys have made or case studies from the past?
Yeah, we don't talk about current investments much, but we do talk a ton about case studies and past investments that we've made, what we looked at. We reverse engineer picks from other investors have made, that are reported, just to try to see, what is it that they're seeing and what's attractive to them.
Now, when you go about your own investment process, help us understand a little bit how you see your investment universe and what are the types of companies you guys tend to focus on.
Sure. Our universe is actually about as big as it gets, being a smaller fund, and we're willing to go wherever it's cheap. We look for good businesses typically that, it's especially attractive if they can reinvest into high ROIC projects. We look for good management, with good capital allocation, which share buybacks if they're doing it at the right time, not paying a ton. Then obviously we want to pay a good price for it and maintain our margin of safety. So we scour the globe looking for attractive investments that, good businesses that are selling for unreasonable prices, really.
And do you use? Yeah, go ahead.
Well, I was going to say we kind of have some proprietary software that we've built that it really scours the world's markets and kind of displays the results to us in the order of how we think and what we find most attractive. And what's really awesome about that is we can look and see what's available out there and compare it with what we're currently holding, and basically gives us an instantaneous opportunity cost of every stock in our portfolio.
And is that something you guys developed? Is one of you guys a programmer or?
It's funny. That's one of the other tangible benefits of teaching the class is that we come into contact with some very smart people that do things a lot better than we do. Neither one of us is programmers, but there are programmers in our class, and they've helped us out with some of these projects. So it's it's really a cool resource to have at our disposal.
And what are some of the metrics that you would use to sort of eyeball how cheap certain equities are around the world?
Yeah, I mean we use price to book, price to sales, price to earnings, net current asset value basically. We also look at if a take a company's earnings basically and assign it an 8 to 10 multiple, and then add the cash in there, and how does that compare to the price? So, kind of what would it sell for on a private market or what in a private transaction under more normal market conditions, and that kind of gives us an idea of what maybe the potential upside of a business might be.
Do you guys like the Joel Greenblatt style magic formula screens then as well?
Oh yeah, we love that. Joel is a genius as far as we're concerned, and largely what our proprietary software does is not all that dissimilar from how he generates the magic formula list. With ranking and and ordinal values for everything. So yeah, we're definitely huge Greenblatt fans.
And when you go across the world to actually do this, you do this on a company by company basis, right? Or do you try to also see how cheap different countries or markets are?
Well, that kind of goes back and forth. You know, we we also sometimes we'll screen for ETFs that are and try to find price to book. It's a kind of an easy way of getting the universe laid out for you of what's cheap, and then from there you can drill down into for instance, we're big on Japan right now, just relatively the relative attractiveness of it, and you come across it on an ETF, and it's like, okay, this is really cheap, so let me go see what I can find inside of there. So there's kind of ways that you can shortcut finding what is cheap out there through rolled up information that's in an ETF.
And Japan has a lot of nets, it seems, the real kind of Ben Graham style bargains. So do you guys then also look at those? So you basically span the whole gamut of kind of value investing, if you will.
Yeah, we're comfortable with either. There's different flavors of cheapness and value, whether it's earnings based or asset based, and we it makes a ton of sense to us to get a bunch of things on a balance sheet for cheap, and it also makes a ton of sense to us to get a good business, that's for relatively inexpensive. So, we're willing to go kind of wherever the value is, whether it's assets or earnings.
In a place like Japan, do you then actually try to find the few companies that are maybe the cheapest, or would you take a more of a basket approach to that kind of situation?
Well, we definitely take a basket approach, although not like currently we own about 14 or 15 in the fund, but there's they don't make up more than 25% of our fund. That's kind of where the rules that we have is no industry or country makes up more than 25%, with the idea to do some risk mitigation there. But we take a pretty basket approach in that we don't overbet, hopefully, on any one idea. We just kind of look at each one like a positive expected outcome, and let get equal position size of each one, say 2% or so. And part of it is that with the Japanese, neither one of us speak Japanese or read it, so we're at a little bit of an information disadvantage. But because we can't do the real thorough digging that we would normally do in a U.S. stock, that kind of limits how much comfort we can take in assigning a position.
And in terms of a place like Japan, so do you feel like they're just way too cheap, or do you have a sense that maybe they're getting their act together in terms of capital allocation, maybe ROEs can go up over time? What's kind of the main thesis for you there?
Well, it's definitely it is difficult to read, really smart investors like a Kyle Bass who, puts forth a very strong argument for why Japan is in serious trouble. And he's short government debt. And one thing to kind of remember is that we're not long Japanese government debt. We're long individual smaller companies that provide goods and services every day to Japanese and other people around the world. And so it's just that whole problem of you pay a high price for a rosy outlook. We feel like the sentiment is so extremely bearish on Japan that that's what's creating these opportunities. And it's so you have to kind of dig through the dumpster sometimes to find these great companies that are being thrown away. I mean, for instance, we have kind of our top three ideas in Japan. They've all been profitable for the last 10 years running, and they're trading for less than basically cash on the balance sheet. The business is free. So it's in us, like when we try to take an outside perspective of let's say a Martian came and was looking at businesses to buy. If he saw a company that was trading for less than cash on the balance sheet and yet it had been profitable for 10 straight years, it wouldn't make sense to him. So we kind of feel the same way, is that this just to a normal business person, leave out all the macro, everything. It's just unreasonable how cheap some of these trade for, and so that's what we're trying to take advantage of, is that negative sentiment that's pervasive, really.
Yeah, and it seems like if the Kyle Bass thesis on Japan were to come to pass, it would lead to a depreciation of the currency, and a lot of Japanese companies are phenomenal exporters, and it could actually help their businesses.
Yeah, there's a lot of sort of situations like that with Japan where it like one thing moving kind of helps in another way, like there's sort of counterbalances in there, and we certainly that's kind of one of the reasons that we haven't done any hedging, is kind of for that same reason, is that it just seems kind of expensive, and it seems like the businesses will do better if the currency depreciates. So we kind of try to be agnostic on that.
Mm-hmm. Now, in terms of the portfolio itself, how big do you let a position get? If you have a great investment, how big would you make it initially? And then if the stock goes up, at what point do you say we need to start selling this?
Yeah, for a typical U.S. business that we really like a lot, we still don't make more than a 4% bet. We're in the whole grand scheme of concentration, we're relatively concentrated, but we're no Munger or a Li Lu with like 3 or 4 positions. We just don't ever feel confident enough to put that much into one idea. So 4%. One of the things that we do try to do is, we kind of have a feeling that markets, obviously, if you believe in efficient, or if you don't believe in efficient markets, things sell for cheaper than they should. But then we also feel like things overreact to the upside. And so we try to take advantage of that a little bit by being a little bit more mechanical in our selling strategy. So we'll typically wait for at least a year before selling anything, with the idea that we're going to give this time to both, a situation to work out, and also, we want to get long-term gains treatment. And like I said, if for whatever reason things do turn around and it goes crazy, we don't mind getting a little bit of extra to the upside in the irrationality department. So I think that's one of the. I'm hoping that's a little bit of extra way that we can deliver better results than average. We kind of have this. We did this study where we looked at all of these different value investors and the annualized returns of them over all this. Like it was a longitudinal study looking at all their returns year after year after year. We compared those to the S&P 500, which lots of people have done that kind of study. But then we also compared it to all of these value studies. Like so, the Tweedy Brown study, the What's Worked on Wall Street. We found pretty much every study that was out there and laid it out along these years and compared that with the gurus. And what we found is that these studies were largely beating the gurus. And what we couldn't figure out was, these are the smartest people in the world. How is this mechanical, buy it cheap, sell it after a year, how is that beating them? And the only thing we could come up with was that that there was that participation to the upside of irrationality that the guru would have never taken advantage of because it wouldn't make sense to them. So we try to expose ourselves to that a little bit, and we want to approximate the studies largely because if we do, we're gonna be pretty happy with the results.
Now, when it comes to qualitative screening and evaluation of potential ideas, can you tell us a little bit about how you guys evaluate management, their incentives, and what you like to see on that front?
Yeah, we obviously want to see management have some skin in the game, just to have the aligned incentives. I'd like them to own. In fact, I'd love to have the situation where it's management and then we're the only other investor in the company. That'd be ideal. But, with public markets, that doesn't happen all that often. We also are big on how they allocate capital. So, one thing is after 10 years, and if you have the retained earnings as like 10% of the net worth of the company, then that current manager will have allocated 60% of all of the capital that's deployed in a business. So what that means is that it doesn't take that long before capital allocation really starts to make a big difference, even in a bigger company. So that's really important to us. What are they doing with their cash? Are they putting it to good use? So really, that's kind of what we mostly look for with management. And we also want them to do what they say. So we'll go back and read what it is that they're saying they were going to do, and then we'll try to compare that to, okay, well, what did they actually do? So,
what are some managers, maybe if you could tell us a few that you guys have come to like in your experience, maybe that are a little bit less well known to the average value investor?
Well, I'm a big fan of Jeff Bezos of Amazon. He's not really value investing, but I respect his long-term vision and his ability to ignore Wall Street. Another one I really like is John Mackey. I actually had the pleasure of hearing him come in and talk to one of my MBA classes, and he's a really inspiring guy. He has a really powerful underlying why his company exists and what they're doing, and you could see that it fulfills the employees at Whole Foods on a level higher than just here's a paycheck. Like I think that it moves up in Maslow's hierarchy of needs into some of these other more fulfilling areas. So he's pretty interesting. My favorite, I think that Buffett as a CEO is actually kind of underappreciated. His ability to design incentives is particularly amazing. With Todd Combs and Ted Weschler, the way that they have it set up is they have a $1 million a year salary, so that's kind of their safety net. They're not going to be desperate. Not that either of them needs that much money, but that's kind of the idea. And then they get 10% above the S&P 500 that they deliver. So any returns that they have above 10% or above S&P 500, they get to keep 10%, and that's on a 3-year rolling average. So it gives them some longer term thinking. And then they also have to share. They get 80% individual score and then 20% collective. So he's kind of incentivized them to work together. So he's very good about that. And then obviously everybody knows about his capital allocation skills as a CEO. But I was marveling we were at the meeting this past weekend in Omaha, and he was talking about this $1 million bet that he made with this fund of funds on whether they could beat the S&P over a 10-year period. And so it was going to be paid off, that $1 million, in a zero coupon bond, and he had put in about $300,000 to start. That's what he bought the bond for. and it's worth now about 400,000 or 500,000. So he had asked this fund of funds if he could sell that bond and write them a guarantee for $1 million, and he wanted to buy back more Berkshire with that money. So here's a guy who's worth $50 billion, and yet he's still thinking about allocating every dollar that he has out there as if it was his first dollar. I mean, he's willing to try to trade up, $300,000 into Berkshire stock instead of this bond, even though it's kind of a pain. And you think, man, he just has different wiring than anybody. Like, he has no diminishing marginal utility for each dollar. Every dollar is as important to him as the last one. It's kind of a rarity.
That's interesting. What else did you, just curious, any interesting takeaways from the Berkshire annual meeting? I don't know, it's like my observation, could be not to add something more than what you could find online just from actually being there. But one thing I would add maybe is that they both seemed in really good spirits. In years past, I think this is my sixth trip to Omaha. They weren't as in good a mood as they were this time, and I don't know what exactly that's attributable to, but it kind of gives you hope that they're going to be doing it for a lot longer. So, other than that, I think there wasn't a ton of news information, but it's always kind of nice to just go. We kind of consider it like going back to church, or it's kind of our pilgrimage, and it gets us re-energized to come back and get back to work. Yeah. Can we talk a little bit about actual ideas? Do you guys ever talk about ideas you're invested in, or you like to keep those to yourselves?
We typically don't talk about ideas, but we're making an exception for you.
Thank you.
We have a few ideas that we can share.
That would be wonderful. If you could tell us your thesis on some of the companies you like.
Sure. Our thesis is it's going to be pretty simple. It's always very cheap. That's kind of our
good thesis right there.
So the first one, those are all Japanese companies. The first one is 9193, and it's a Tokyo Kaizen company. And what they do is they make tugboats. And so it's pretty simple business. They make sightseeing boats and car ferries, stuff like that. And then they also, which is kind of weird about Japanese companies, a lot of them have very different segments. Like, because these guys also do a restaurant segment, which you would think, why does a tugboat company also have restaurants? But all these Japanese companies are like that. But just some quick stats on them. They're at a price to book of 0.3, price to net current asset value of 0.65. So it's like right in line with the Graham 0.66 net that he was so fond of. Price to cash of 0.56, and a price to what our value, what we think it's probably worth, is about 0.31. So it's like basically 30%, selling for 30% of what we think it's worth. So it's pretty simple business, but just being given away right now, basically.
And what's the
profitable for the last 10
cap?
years? 10 years straight profitability.
Wow. What kind of market cap does it have, roughly?
Well, all of these are below 100 million. So these are all very small ideas. And
this particular one that you mentioned, so it's, did you say 0.56 times cash? Is that net cash?
Yes.
Wow.
Yeah, no, almost none of these companies, almost no Japanese companies have much debt, really.
So it's profitable and trades at about half of net cash.
Correct. Profitable for 10 years straight and trades for net cash, half of net cash.
Isn't it amazing that they don't just buy back some shares or something?
It is. It's that is. I mean, that'd be the holy grail if you could somehow, take over some of these companies and try to unlock value yourself. But I know people have tried that with pretty limited results. But I think if if you believe in value and believe that value is its own catalyst, then and we're gonna hang in there. Hope it happens.
What's another company that you like in that
Yeah, this
area?
next one is Natoko company. It's 4627. That's what it trades under. And this one is just basically manufactures and sells paint and chemical products. And it also does a little bit of transportation and disposal of industrial waste. So, nothing too exotic here, really. And this one, same thing, 10 years straight profitability. This one's trading for zero point 0.4 of price to book, 0.7 of net current asset value, so a little bit slightly above Ben Graham's 0.66, but still pretty cheap. 0.87 of price to cash, and then we think it's about trading for about 36% of what it's really worth under more normal market conditions.
And when you're buying these kinds of companies, what kind of commissions hit do you take just roughly? Are we talking a few percentage points or?
Well, we actually we trade through Schwab because we're always looking to cut costs however we can. We haven't found anybody who do things cheaper than Schwab will for us. And honestly, we had a full budget broker, full service broker before, and we just weren't getting any value out of it. I didn't feel like they were working trades, and it was just like, well, I could do this myself and save a ton of money. So we use Schwab, and we're paying for Japanese, it's $100 a trade. So it doesn't, however many trades or however many shares you want to do. So it's pretty reasonable, really. It doesn't take a whole lot of money to put to work before that percentage gets pretty low.
Right.
So,
interesting.
Although I will say that the volume can be a little difficult on Japanese stocks in general. It takes a little bit of time to get into positions, but we're pretty patient, and it's we try to take a little bit longer term view to it and not get too big a hurry and overpay.
Do you have another one from Japan?
I do. I have one more for you. It's this is Nakano Refrigerators Company, and it's 6411. And they, like the name says, it's manufacture, sale of freezing, refrigeration, mostly for like food, like store, showcases, what you like an end aisle cap that you would see in a grocery store. And of course, like any good Japanese company, they also have a real estate leasing business on the side. So this one trades 10 years straight profitable. This one's at 0.7 price to book, 0.9 price to NACV or NCAV, and 0.6 price to cash, and about 0.3 of what we think it's worth versus what it's trading at. So these are all kind of in the same line of 10 years profitable, and trading for super cheap. And actually, I could tell you the stocks, 15 or so stocks that we own in our current basket. On average, they've been profitable for 8.5 out of the last 10 years. They have price to book of 0.3, price to NCAV of 0.47, price to net cash of 0.5, and price to value like about 30%. So all in line with what these three. So we've been able to find 15 of these similar situations and get into them. So we're pretty happy with it. I mean, I'm excited to see where it goes.
It sounds a little bit like that basket that Buffett bought in South Korea a few years back, where he was just basically picking from a list, and they were all so cheap that it just was a no-brainer.
Oh, absolutely. And that's kind of how we try to look at it. Is we try to look like we're running a casino, really. Every person that comes in the door and every roll of the dice for a casino is a positive expected outcome. And we feel like this basket, it has a positive expected outcome for each one. We don't know which one is going to be which, but just like every game that the casino operator puts out, they know that it's net a winner. That's how we feel about these. So the only place that you can really go wrong is if you allow them to bet too much on any one roll of the dice. That can kill you. So position sizing fixes that. Um, and we basically just let time work on our side and hold this basket and hope for the best.
If one of your holdings goes down a lot for whatever reason, do you feel inclined to buy a lot more to maybe get back to that 4% allocation or something like that?
Yeah, that's typically how we run the portfolio. As we get new cash in, we try to stay as close to 4%. The Japanese one is a little bit different within our portfolio because we made it half-size bets, but typically we try to keep it at 4% for everything, and we have no problem adding to positions as they get cheaper to lower our average cost. So I think we actually kind of like buying in a falling market like that. Like we don't consider it catching knives if you take a little bit longer term view of we're always too early, and we're typically too early selling too. So it's kind of the nature of value investing. You're going to get in a little early and probably get out too early, but you're going to buy low and sell high in the meantime.
And what are maybe some of the lessons that you've drawn from just the past several years of market turmoil and the big downturn in late 2008, early 2009? Do you feel like your investment process or risk tolerance has changed at all as a result of that?
Yeah, I think 2008 was a good lesson in position sizing mainly. Before in personal accounts and other, we've run 10 by 10, similar to Monish, what he was doing, and it kind of makes you, 2008 makes you appreciate more of the things that you don't know, that you never realized. So we're always trying to look for ways to take our own biases out of our decision making, and we feel like going to a 25 by 4 as opposed to 10 by 10 gives us a little bit more, takes us out of the equation a little bit more. You have to be more right on a 10 by 10 than you do 25 by 4, I feel. So, and it's the other thing that was, it makes you appreciate even reading all the studies and having a lot of faith in value investing. It's a rough ride to go down and lose people's money, and we came back strong, but it still is, it's not easy. You can see why it takes its toll and why people start to scramble and groupthink develops, and look for safety in numbers. We typically love volatility because it brings us opportunities, but what we didn't like about that 2008 was the high correlation. It was everything went to one basically in correlation, and you just couldn't. There was stock picking didn't matter at all. It just all the bottom fell out for everything, and that's looking back at past market crashes. That hasn't been the case always. A lot of times value investors have done particularly well in crashes, but this time nobody was spared. So definitely is it tests your mettle, but we feel like it's probably not the last one. I'm 31 years old, and I know that's not the last big market crash I'm going to have to live through.
Well, that's probably right. Are there any industries that you guys have found yourself gravitating toward, just in terms of finding a lot of interesting companies in those industries?
We're pretty industry agnostic. We don't profess to have any insight into any particular industry. There's been some larger cap techs that are pretty attractive, recently. I think pretty much every value manager knows about these. Microsofts and Dells, and but we could see the attractiveness of those. We've also looked at I think some of the bigger financials are pretty attractive right now. Just they're certainly much better capitalized than they were. I'm still a little bit leery about some of their liabilities, but we're kind of increasingly of the opinion that that they have a pretty solid federal backstop that limits a lot of those liabilities. Although it still makes me a little bit nervous. That's so. I mean, our the answer to that question for us changes with whatever market conditions. We don't go to any. We don't have any one sector that we look at and say, oh yeah, this is ours. We know what's going on here. We just kind of we're instead looking for whatever is screening for cheap at this juncture, and that's what attracts us.
Are there any sectors or industries where you say we don't want to go there because it's maybe outside of our circle of competence, or?
Well, we avoid places where we don't trust the accounting. So China, Russia, some South American countries. But in general, not really. We go, like I said, wherever it's cheap, and if it's really not. We don't throw things out for too many other reasons other than it's too expensive.
What would you say are some of the biggest mistakes that investors tend to make?
Yeah, I would say kind of splitting that up into a two-part answer. Small investors, I think the biggest mistake they make is market timing, and the shining example to me of that is the best performing mutual fund from 2000 to 2010 was the CGM Focused Fund, and it returned 18% annually, yet the average investor in there lost almost 11%. So they got in at the wrong times, they got out at the wrong times, and so we think that's probably where small investors get hurt the most. As far as professional investors, and we're certainly not casting any judgment because we've been guilty of this in the past too. But I think overconfidence bias is the biggest problem, and where that shows up is in position sizing and leverage, and which really are kind of the same thing if you think about it. But we've overbet in the past, and so now we have pretty strict procedures in place to keep us from, no matter how excited we get about a particular idea, it's not going to be too big of a position to hurt us. And so I think that's probably where the two biggest areas of that maybe people could study a little more and improve.
And before we let you go, could you share any interesting books that you could recommend to fellow value investors?
Yeah, I just finished reading Daniel Kahneman's book, Thinking Fast and Slow, and in it he describes all the different psychological studies that him and Amos Tversky did over the last 50 years or so. And it's also kind of part autobiography, which is really an interesting read. And I had seen many of these studies in other value investing books, most notably probably James Monnier's work. But to actually read Kahneman's take of what inspired them to how to put that study together, and it just gives you a richer understanding of the psychological biases that you can fall to be impacted by. So it's a pretty interesting piece. In fact, I think the next article that I'm writing is going to be on the anchoring bias, where it could be any number, it could be a random number and it will anchor your estimation of something else. So, for instance, they just took people's social security numbers and had them guess what something was worth, and the higher the social security number, the more likely they were to guess a higher number for what something was worth. And so, Buffett has been famous for saying that, he goes and he'll look and try to figure out what a company is worth before he looks at the stock price. I think that's pretty huge to not be anchored by what the stock price says before you try to figure out what it's worth. So that was the most interesting book I read recently. I think the other two that I read in the past year that I think might be useful for value investors would be They're both by the same author, Matt Ridley, and it was The Rational Optimist and Genome. And in it, basically, all what I got from it was that, it's so much pessimism in the world right now with, government debt and, economies that are languishing and we're muddling through. But if you take a little bit longer term perspective, it's actually a pretty amazing time to be alive with, potential technological advancements and there's just lots of good reasons to believe that the tomorrow's going to be better than today. So if you have that kind of in the back of your mind, the this time it's different phrase, which is comes all from everybody, is you can kind of see past that and go, no, it's probably not really different. I think we're still going to have reversion to the mean, and if anything, the mean's getting better. So that makes it a little bit easier to have faith in buying things that are undervalued right now.
Well, Jake, thank you so much for your time and your insights today.
Oh, it's my pleasure, John. Thank you.